Funding for Market Journal is provided by the Nebraska Corn Board.
When we transform Nebraska corn into ethanol, it doesn't disappear from the food supply. It just takes a little detour. Ethanol is made from the starch. The rest of the corn becomes livestock feed to create meat and dairy products, corn oil, sweetener, and other food ingredients, and maybe a little carbon dioxide to make your soft drinks fizzy. Homegrown ethanol helps satisfy America's hunger for energy and the world's appetite for feed and food. Nebraska's family corn farmers, sustaining innovation.
Market Journal, television for agricultural business decisions, is a presentation of the University of Nebraska-Lincoln's Institute of Agriculture and Natural Resources. Promotional support is provided by the Nebraska Farmer Magazine, and major funding for Market Journal is provided by the Nebraska Corn Board.
Welcome to this week's edition of Market Journal. I'm Jeff Wilkerson. On this episode, Mike Briggs looks at the rally in cattle prices. Justin McMechan talks about assessing the condition of planted corn. Tina Barrett discusses net farm income, and Jim MacDonald describes research on predicting feedlot performance. Mike Briggs is our cattle market analyst this week. To describe the recent price movements in cattle markets as a rally seems almost understated. The June live cattle contract increased nearly 12% during April and closed higher than the previous day on 16 of the month's 19 sessions. And the first 4 days of May saw the contract soar another $10.50. This comes as the USDA's latest projection 2.5 weeks ago showed farmers and ranchers would produce 5% more beef in 2017 than they did a year ago. We talked with Mike Wednesday morning and began by asking about the run-up in market prices.
It's a lot of fun, man. This has gone way past anybody's expectations. I was one of the more bullish guys out there. This thing's gone $15 past anything could have ever thought of, but it's one of those things where a lot of things came together at the right time, and it's been very, very good for the cattle producer.
Dissect what's led up to this rally.
15% increase in exports, which I'm not smart enough to put a number to that, but it's worth a lot. Domestic demand has come around. They finally lowered all the complaining that you've seen me and other producers do for the last year. They finally lowered prices in the store, and demand came screaming back because people want to eat beef, and that's great. So you've seen that come together. Plus you've seen, and what I think is probably one of the biggest things from an overall standpoint, is you've had an overall bearish opinion in the board as far as the Board of Trade has, and so has made a certain amount of fear out in the country. And so you've had the board price much lower than cash. So anytime you have cash over the board, there's a huge incentive for us producers to move cattle quickly. We've moved cattle very quickly to the point where we're selling them 40 pounds a head lighter than last year. So last week, in fact, we processed 3% more cattle than the previous year and only produced 0.5% more beef. So we've been able to shove a lot of product through this thing, keep our weights down, and we're very current in the feed yards, and that puts us in a really good situation.
And the Packers been able to handle that much supply?
To this point, the Packers been able to handle this much supply. One of the numbers is out there is the max they think they can process right now is 625,000 head a week. We did 624 last week, so allegedly we're there. I don't think we're going to process that much going forward because they're not making the kind of money they were making, and they don't like that. But we're kind of at our max slaughter capacity, so we're shoving a lot of beef in the market, but yet since cattle weights are lighter, we don't have the tonnage there that we could have, and that's what's helping us out.
Slaughter weight's down 20 pounds an animal in March. You would expect April would do the same. Last year cattle were very heavy, but how many days in the feedlot difference are we talking here? A
lot of people like to brag or talk about how far out front they're selling their cattle. I had cattle on the show list last week that I couldn't even get a bid on unless I wanted to sell them at a discount because they didn't have enough finish on them. Everybody's very current. I would say we're 2 to 3 weeks ahead. Some people would like to say we're 30. I can't market cattle that are 30 months ahead, but we're definitely ahead of schedule. Now, the interesting thing, the cattle that are contracted so that they're priced already at a much dramatically lower price than what cash is today, you're going to go ahead and feed those out to their end point because you need the pounds to make up the money. But right now everything's kind of going our way.
Total game changer for supply in summer, right?
Oh man, we had a tsunami of cattle coming at us, and we've pulled a lot of those cattle ahead. And it's not just the fact that we pulled those cattle ahead, we're putting less pounds of beef in the market. You saw cold storage be down. We're drawing out our cold storage stocks, and we're putting less beef on the market than was anticipated, and that's just gonna help us down the road. Now, I still think we get into the end of summer, and I still don't like this thing. Now, are we going down to 85 cents? No. But you're probably going back under $1.10, maybe down to $1.05. And if you're buying $1.10, $1.15 break evens, that doesn't work very good. So you have to be careful.
Because the reason you think that is because?
There's just too many cattle coming at the market. If you looked at December and January placements, you have huge numbers coming at you. Those cattle go right into that July, August timeframe. That's always a poor demand timeframe on top of that. And somewhere here, the big incentive, as I said earlier, the basis where cash is over the board, that's gonna flip. You're not gonna have the incentive to market those cattle. We get a little bit behind the 8 ball, and as we typically do, we just make them bigger. So I'm not saying it's gonna happen, but the potential is there for it to happen.
Give me an idea of where margins are at in the feedlot.
Margins are pretty outstanding right now. If you didn't do any risk management at all, you're probably making $500 or $600 a head, which is kind of the equivalent to what you were losing last fall, so it's kind of nice to get that back. The probably unfortunate thing for a lot of producers, the banker was making some marketing decisions for you last year, and a lot of cattle are hedged because producers needed to make money. And so I don't know what percent of producers are really taking part in this. Even us, to some extent, we priced some cattle early to make sure we had some margin made. Now we've been able to catch in on some of this at the end. I don't know anybody that's gotten all of it because nobody saw this coming. I don't care who you are, but it is a good time, and we needed it as an industry. We've lost a lot of equity.
We talked long term, more short term. Where do you think the markets go?
I think we're pretty good here. You know, we're always good into Memorial Day, and then it starts to stumble, and I really don't think there's gonna be a lot of difference in that. You're gonna start coming into more supply of cattle after Memorial Day, but I think we're good here into Memorial Day demand, and then the market could stumble a little bit, but the market could stay right where it is for 2 or 3 more weeks. But at some point, it's gonna erode away. It always does. You're gonna have more supply of cattle. This isn't gonna stay here forever, but I think we're good for a couple weeks yet.
Next week, Doug Simon from Trade-Offs will join us to look at corn and soybean markets and the USDA's May crop report. A late April snowstorm dumped more than a foot of snow in some areas of Kansas and spread up to 10 inches in certain parts of Nebraska. With the reporting cutoff of Sunday, the condition of the U.S. winter wheat crop was unchanged from the previous week, but issues may appear in Monday's next USDA progress report. In Nebraska, 34% of the 2017 corn crop had been planted, with 3% listed as emerged. On Thursday, Nebraska Extension's Justin McMechan joined us to describe how growers can assess the shape of corn put in the ground before the cold, wet weather moved in. But we started by asking what would happen to any corn under snow.
Snowfall's a new one for us, and we did some searching through the literature, and we haven't found a lot on impacts of snow on newly emerged or emerging corn. So we're going to reflect back a little bit on temperatures and what we know about temperature. And when I think of snowfall on corn, I think it's a buffer against atmospheric temperatures to prevent above ground freezing, but then it's also going to melt and potentially move into where that seed is germinating. And so that's a bit of a concern because it'll lower the temperature around that seed. And in particular, we're worried about corn that was planted maybe just 24 to 48 hours before this hit. Because that corn could potentially, once it starts imbibing water, it'll start expanding. And if it's too cold, it's not elastic. And so essentially that seed breaks open and we lose our germination. And so that's a big concern. And what I would warn growers, I guess, now is to just kind of leave those fields, set them aside, and continue planting if they still have planting to go before they start evaluating.
If there are any concerns with frost issues, and I think it would have to be small pockets of the state, what would growers look for there? Yeah, I took a look at temperatures, and our indication is that we probably didn't hit a lot, but there are probably, like you said, a few pockets that could have some frost damage, and a lot of that can look bad initially, especially if you've got V2 stage corn, which is probably some of the most advanced corn we had. That dead tissue, when it starts to regrow, it's going to be in the way of the newly emerging tissue. So essentially what we can get is wrapping of those leaves or tying up of those leaves, and lots of growers get concerned and would like to cut that tissue off. And
we advise against that. There's been a lot of studies. Roger Elmore here at the university did some in the late 1980s, and essentially what we get is an issue where when you cut that off, first of all, you can push pathogens across the field and essentially spread them across the field, but then also we just don't get a good yield response. So be patient. Most of the data indicates that if you don't cut them, they seem to do fairly well.
Perhaps the more widespread problem would be growers who planted before that cold, wet weather moved in. Mm-hmm. What should they look for?
Yeah, depending on what stage, or right before you planted, and what stage that crop was at when it was hit, is going to affect how you evaluate. And if you've got emerged corn, I suggest you dig up a few plants and cut them longitudinally. And basically, what you're looking at is that underground portion and whether or not it's white. If it's nice and white, it's a healthy plant. If it's turning a slight brown color, then you're facing some issues. At least that plant seems to be compromised. And so that could be due to bacterial pathogens, or simply that plant has been killed off by frost.
If it's not emerged?
If it's not emerged, then we go back to the imbibing water and that seed expanding and swelling even after that. So that's part of the germination process. But those, you're going to look for seeds that really haven't done anything since they've been germinated. But those that have and have started to develop a small mesocotyl, which is the newly part that just emerges out of that seed and is headed towards the surface. Cold temperatures can also affect that area. And what we get is what we call a corkscrew, where the leaves emerge underground, and it's certainly not good and most likely a fate for the corn that it's not going to produce much. But looking for those types of conditions and whether or not you have an issue would be important. So you'd be changing your evaluation based on what your corn was at prior to that cold event.
How hard is it to decide whether or not you're going to replant?
It's tough. So I'll refer people to an article that was produced in CropWatch that focuses on what is the minimum planting population. The On-Farm Research Network did a 4-year study on kind of what the minimum populations were, and that's going to depend on whether or not you have irrigated ground, you're rain-fed, and then what your yield potential was. So if you're above 115 bushels per acre, you're going to have a different minimum population that we would recommend.
Finally, how concerned are you with disease issues?
Concerned, because it's been cool and wet since we had this initial cold snap, and that certainly favors a lot of diseases. Pectobacterium's one. So when we're evaluating, we want to be patient because those don't immediately show up. And so I really recommend growers take their time to evaluate. The key thing is moving forward is when we wait, we lose yield in terms of the next planting date, and I understand that, and that's what growers are thinking about. But if this is a crop that's actually going to produce still, you're saving money if you can wait to make that proper evaluation.
You can find the CropWatch article Justin mentioned through a link on the Market Journal website. This week's issue of CropWatch also contains more information on assessing corn. Further, if you had corn under snow, Justin says UNL researchers would be interested in hearing from you to learn more about any issues it might have. The U.S. Department of Agriculture Monday released production costs and returns for field crops, including corn and soybeans. The agency's numbers showed, on average, better yields and an increase in prices turned soybean returns from negative in 2015 to positive in 2016. Corn remained in the red for the third straight year, but narrowed losses. It's important to note the numbers don't include government payments. The USDA's February estimate of net farm income in 2017 predicted a 9% drop compared to last year. That would follow a 16% slide from 2015 to 2016. Tina Barrett from Nebraska Farm Business Inc. joined us Monday to discuss 2016 numbers. When we talked Monday afternoon, we asked what she found when looking at net farm income for her group of producers.
Well, what we found as a surprise was really it. We saw net farm incomes increase to about $46,000 this year. That's a 50% increase over last year, which sounds bigger than the $16,000 increase, but still an increase wasn't what I was expecting, and I don't think what most people were expecting.
Yeah, certainly surprising. So where did the increase come from?
Well, it's kind of all over. I think maybe the best explanation I can come up with is that when producers who participate in our program get the analysis each year. In 2015, we saw 44% of them have negative net farm incomes. I'm thinking that caused a wake-up call that made them go back to all their expenses and really dig into cost control, because we really didn't see major increases on the income side of that net income, the gross income side, other than maybe soybean yields, which we saw record high yields. And I can't pinpoint seed, fertilizer, chemicals, or any of those major inputs as the big cost decrease. In fact, it just looks like it's little things across the board that made up that difference.
Was there a big difference between crops and livestock?
Yeah, and that was a big difference. The beef industry continued to sit at the bottom of the pile and saw continued losses, where the crop guys kind of rebounded. So when I pull out that crop segment, for those that have 70% or more gross income coming from crops, they rebounded to their 2014 levels and back up to a good income. And so there was definitely a difference in that division again in 15 or in 16.
Yeah, how helpful was ARC PLC, those government payments?
You know, on a per acre basis, we saw a little bit of an actual increase per acre, not a lot, a couple bucks. But again, it looks to be like those little things, those couple dollars here and a couple dollars there made a big difference.
So the difference between the high cost and low cost producers, or the ones that you're seeing improvement in versus the ones that you're not, what are the differences?
You know, I think there's some big things. You know, debt structure is one of those. We continue to see about 25% of the farms we work with have negative working capital. I'm thinking they're probably different farms, and those that were kind of in that yellow cautionary place in 15 slipped ahead into the what we'd consider red, where those that were in the red last year kind of got refinanced into a good position. So some of that is probably happening still. But we're definitely seeing those who continue to sit without a significant debt overload doing better than those who are.
Debt to asset ratios.
So on an average, we're sitting about the same, you know, rounding up to 28%, both in 15 and 16. Again, a little bit of an increase over the last 5 years, nothing dramatic. Again, I think we're probably going to be okay there unless we start to devalue assets like machinery and equipment, or if land values drop dramatically.
There was a point in one of our recent interviews where you said, I feel like I'm always talking about family living. Well, did it make a difference?
It did, yeah. We saw the first significant drop in family living expenses in a long time, maybe ever. Family living was down $9,000 or about 10%. So, you know, that's huge. That's a big difference. And we're starting to see that. And that was one of the things that correlated into a smaller net worth loss. So we still did see a little bit of an average net worth loss, but it was about $20,000 less than last year.
So how do you use this data? Where do producers go from here?
Well, you know, there's lots of stuff that we can do. From an individual standpoint, you know, producers being able to benchmark their operation against this data is huge, to be able to find places where that they can look to see if they can improve their operation. In general, though, I think the data is telling us that there's some hope and some positive time out there, that at least some producers are finding ways to turn this around, and we're not getting to profitability times of where we were in 2011, 2012, but at least at a sustainable level. And so I think that's exciting.
Tina says while the $45,000 net farm income number sounds good, it represents a return to not only a producer's labor and management, but also to the significant investment of equipment, land, and other assets. With an average of over $3 million invested, she says this return is marginal at best. Tina also says while the reversal in profitability is encouraging on the average, not all producers are seeing this positive result. You can find more details on the numbers in Tina's recent CropWatch article at cropwatch.unl.edu. The Maine Nebraska farmer says Tyler Berkey has been described as a non-traditional farmer. This month's issue says that's fine with him, as he's designed his cow-calf system west of Milford to be anything but normal. In this case, that means flexibility for the next generation. Tyler and his wife Megan have 2 children, son Luke and daughter Sydney. The Berkey operation makes use of hoop buildings, perennial pasture, annual forage crops, and crop residue, and Tyler hopes is adaptable enough to pass on to his children. You can read about the system in the May Nebraska Farmer. The 2017 Nebraska Beef Cattle Report features University of Nebraska-Lincoln research on subjects such as cow-calf management, using residues in forages, and growing and finishing animals. One of the topics in this year's report focuses on predicting performance in the feedlot. Jim MacDonald, a UNL associate professor in the Department of Animal Science, is part of the group looking at that issue. He joined us Wednesday in the R.B. Warren Arena to explain how predicting performance can be beneficial.
The principle of marketing cattle is to be able to continue to put weight on until the cost of putting on that additional pound of weight exceeds the price that you receive for it. Now, that doesn't always hold true in terms of market dynamics, and we're in that situation right now. But in general, knowing what your cost to gain is very important to targeting a specific marketing date. Now, everybody knows the cost to gain retrospectively because they look at their closeouts, right? but that's on average. And so what's much more difficult to predict is a cost of gain on a daily incremental basis. So what's happening to feed efficiency and cost of gain every day that they're in the feed yard.
You've done some research on this topic. Lay out the study for me.
So we've done a couple of things over the last few years. One of them was a modeling type experiment where we weighed cattle every 2 weeks. We've got a pretty good handle on how dressing percent changes, and so we're able to predict carcass weight as cattle would be marketed every 2 weeks, and then run some regression lines through them. So we were able to evaluate what's happening if you market cattle on a live basis and what happens if you marketed them on a carcass weight basis. And I think most of the industry recognizes commonly held belief that feed efficiency is declining as cattle are on feed. So composition of gain changes, you're putting down less muscle, you're putting down more fat. That's why dressing percent increases with time on feed. That's pretty well understood, and largely understood that feed efficiency is declining with the feeding period. Okay, but that changes in the carcass. That's not as true if you're looking at feed efficiency on a carcass basis. So feed efficiency is much flatter throughout the feeding period if you're looking at cost of gain for the carcass compared to cost of gain in the live animal. And the reason that changes is because dressing percent is going up, and at the end of the feeding period, 90 to 95% of every pound that is added to the animal goes directly onto the carcass.
There's been a lot of focus on the size of animals coming into the feedlot. You looked at the weights of those animals coming in and their efficiency after. What did it show?
In general, a lighter animal is going to be more efficient. You start with a lighter animal, they're going to be more efficient throughout the feeding period because you're putting on a higher proportion of muscle compared to the proportion of fat. A larger animal that's been backgrounded in gone through a yearling system, either in a pen or out on grass, they've already laid down a large proportion of their muscle, and so proportionately they're putting down more fat. They're going to be less efficient throughout the feeding period. However, the change, surprisingly, is very similar for the yearling and the calf fed. And what I mean by that is calf fed might be on feed for 180 to 200 days. A yearling may be on feed for 100 to 120 days. If you change the axis and look at it as a percent of time on feed rather than and as days on feed, because you can't really compare those two, right? Surprisingly, it was surprising to me at least, that dressing percent change is very similar in that larger yearling animal compared to the calf-fed animal. So I think the principle applies that reduction in feed efficiency in the live animal is true, but then when you look at marketing on a carcass basis, doesn't necessarily hold true anymore.
You shouldn't necessarily shy away from those big animals then.
We shouldn't necessarily shy away from feeding cattle longer if it's profitable, and that's certainly been the trend, right? And especially, we're in a much better situation today than we have been previously in terms of profitability in the feed yard. But it's really important during times when profitability is negative, when you're losing money, people tend to want to pull the trigger quickly. And that may in fact be the wrong decision if they're marketing in the carcass. If they're marketing live, that intuition is probably correct. But if they're marketing in the carcass, they may actually be losing more money by selling them early. Pretty difficult for me today to make an argument with somebody who's wants to sell early with the positive basis that we've had and increasing markets on both the futures market and the actual price that they're receiving. So that doesn't really hold true in today's segment. But there's a lot of discussion about wanting to reduce carcass weights, and that's a good thing for the industry. May not necessarily be a good thing for an individual producer, depending on their specific scenario.
You can find more information about the study Jim mentioned, as well as the 2017 Nebraska Beef Cattle Report, through a link on the Market Journal homepage. Al Dutcher is off this week in place of his usual forecasts. We talked Thursday morning with Nebraska State climatologist Martha Shulski to get a seasonal outlook across the state and a recap of current conditions.
So in April, aside from a handful of locations, we were averaging warmer than normal, a few degrees warmer than normal. And actually in 2017, we've remained pretty much above normal on average. And for precipitation, it really depended on where you are. In Nebraska, there was pockets of above normal and pockets of below normal.
Farmers demand to know, what are the soil temperatures?
Right, so they were really going upward throughout April. We were kind of warm in mid-month. And then we had, of course, that really interesting snowstorm that moved across the state, and so that really cooled the soil temperatures down. And actually, our lowest soil temperature that we observed was 34 degrees. That was at Ainsworth, and that's bare soil, 4-inch temperature. So for the last few days, they've been in the 50-degree range.
What does the latest drought monitor look like?
So the drought monitor, we have seen quite a bit of improvement. So only 5% of Nebraska is in abnormal dryness, so the D0 category, and that's mainly concentrated in 2 areas. There's a few counties in southwest Nebraska, and then a few counties in kind of south central Nebraska along the Platte River that are the only 2 areas in the state experiencing dryness right now.
Big change for the state, right?
Big change, yes. So at the start of the year, I believe half the state was in D0 to D2. We even had some D2 conditions. And so over time, we've bounced up and down a little bit, but we've definitely eaten away at those drought conditions.
What does the outlook look like for the state?
So the outlook, maybe something that people would like to hear, is that middle of May, we're looking at increased chance for above normal temperatures, which is kind of a good thing. So there's this big pocket kind of in the central U.S. and Intermountain West of above normal, chances for above normal temperatures, and then below normal kind of in the southwest part of the U.S. and in the northeast. But also increased chance for wetness, so warmer and wetter for that kind of middle of May timeframe.
Further out?
And further out, we're looking at warmer than normal conditions. There's less certainty in precipitation, so there's this small kind of swath of increased chance for wetness kind of in the Intermountain West that just grazes the panhandle a little bit, and then below normal precip in kind of the Great Lakes area. But most of Nebraska's in the equal chances. But warmth is something that people can pretty much bank on here coming up for the next 3 months.
Today's interviews are available individually on the Market Journal website and through the Market Journal mobile app. They include information on cattle prices, assessing options for replant, net farm income, and predicting feedlot performance. As always, you can keep up with Market Journal during the week by following us on Twitter, Facebook, and Instagram. Next week, Doug Simon will be our corn and soybean market analyst. Until then, thanks for watching. I'm Jeff Wilkerson. We'll see you next week.
Join Market Journal online at marketjournal.unl.edu. You can also follow us on Twitter, Instagram, and Facebook. Promotional support is provided by the Nebraska Farmer Magazine, and major funding for Market Journal is provided by the Nebraska Corn Board. Market Journal is produced by the University of Nebraska Lincoln's Institute of Agriculture and Natural Resources.